All right, welcome to Trading Nation. Today we're pleased to be joined again by Professor Robert Shiller of Yale University. Professor, is kind of interesting because a couple weeks ago, some comments you had made first to us, I believe, here on Trading Nation about the possibility of the stock market going up 50% got picked up and turned into a big headline. I know you were on CNBC, which is great. We appreciate that. But, you know, we talked about it before then, and I want to sort of dive in and clear that up. You're not saying we're going to get a 50% gain in the market, are you? You're saying, based on your valuation models, it's theoretically possible that could happen.
Right. Well, I guess it was unexpected coming from me that I would even refer to the possibility. But, you know, the CAPE ratio was 50% higher than it is now in 2000. And I have to admit, I mean, it could happen again. That's all I was saying.
Yeah. So to be clear, you're not saying we're going to get it. Is that Robert Shiller says market's going up 50%? It's Robert Shiller says, you know, if earnings continue to grow, there's a possibility we could add a lot to the stock market. That's it, right?
Yeah, and the stock market is highly priced, but it's not as crazily as it's been in the extreme past. It's not 1929, although it's getting a little bit close to that. Not 1929. And you can't time these markets perfectly. So I would be kind of lean on U.S. stocks and be more inclined to invest in foreign stocks, or at least if you're staying in the U.S., go to low price earnings sectors. There are always values everywhere, you know, every country.
Yeah, so do you have a set view on the U.S. stock market? Can you say definitively, I feel X about the market here now?
I tend to like to give long-term forecasts. And even so, I don't want to call it a forecast, which gives a sense of precision. But I could, you know, if I'm asked to predict how you will do investing in the stock market for the next 10 years, I mean, it's probably positive. It's, you know, probably something better than the federal funds, better than the Treasury securities we have now, which is at 2.13% nominal. And, you know, so
come on, stocks likely to do better than bonds is not a great headline, Professor, as you know. We're looking for juice here, juice. I'm just giving you a hard time, but that's your idea. Stocks should mildly outperform bonds or outperform them bonds over time. What about higher rates? Today was the Fed decision. Obviously, they raised rates. Everyone expected that. They seem to be a little more hawkish longer term, at least in terms of jobs, not as inflation, but in terms of the job market as well. If we get a 3% Fed funds rate by 2019, do you think that would scuttle any stock rally?
Well, 3% is well above the current 10-year Treasury yield. There's a kind of a conflict here between what the Fed is saying. We saw their new dot plots, which are their forecasts. And yeah, they're talking about 3% in a few years on the federal funds rate. So that suggests to me that if they're really going to do that, that the Treasury bonds are not a good investment now. I don't know whether it's real or not. It reflects some calculations of the people in that room in the last couple of days.
But would you call that the biggest risk to the rally, or is it something else? Geopolitical?
See, this is another reason why I wouldn't want to pull out of stocks and put it into 10-year Treasuries. It doesn't look like a good alternative right now. We might see a decline in prices of those bonds.
Yeah, and the 2 and the 10-year bond yield are getting really, really close together. Do you view that as any kind of a harbinger recession? Do you think there is a recession risk, say, in the next 12 to 18 months?
Good question. You know, recessions tend to come always as a surprise. I mean, there is some indicator. An inverted yield curve is supposed to be a sign of a recession. But we don't have an inverted yield curve now. So we don't see any clear sign. But it could certainly happen. You could say it's been a long time since the last recession, getting on to 10 years. So I wouldn't be surprised by just normal market. And I don't know if we're going to set a record for time between recessions. So I wouldn't be at all surprised. But I don't see the indicators, you know, the usual leading indicators suggesting that right now.
All right, well, we'll leave on that semi-positive note. We're not indicating any kind of recession. Stocks should longer term outperform bonds, and that 50% is a basic concept if valuations remain low, not a guarantee. Does that clear it up, Professor?
Glad you asked that. I'm glad you cleared it up.
I try. I didn't go to Yale, nor do I teach there, but I try to ask the simple questions. Professor Shiller, thank you. Appreciate that.
Okay, my pleasure.
All right, sure. Folks, interesting views there from Professor Shiller. I'm Brian Sullivan. We'll see you next time. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.